Morning. Thank you very much for joining me on the Crypto Minute and jumping across. Appreciate it, and we'll carry on with our previous conversation. For those that weren't with me on the DAX webinar, my name is Russell Shaw, Senior Market Specialist at FXCM. My email address is rshaw@fxcm.com. Today is Wednesday, it's the 4th of May, 2022. I'm just going to bring up our high-risk investment warning here. I'll keep this on screen for a few moments. And here is the market commentaries disclaimer. Keep this on screen for a few moments. Hello again, Anna. And here's our references, market scope, trading view. The last chart we were looking at was the inflation on wheat. And Anna made the all-important point, but so first the conversation with Katie is, where's the money going? It's obviously going into where the demand is pushing prices up. One of those places in the dollar. You can see the dollar's moving up, so dollar cash accounts seem to be an option there. Then the obvious question is, but wait a second, you're not meeting inflation, and that's the point. So how is the central banks dealing with it? They're raising rates. What they want to do is they want to moderate inflation, and your interest theoretically starts moving up, and they should sort of ultimately find some sort of equilibrium. So that's the whole economic conundrum that we face ourselves. But what's that got to do? What has that got to do with the cryptos? And I would suggest a whole lot. And the place for us to start with the cryptos, is the US dollar, because I think that the US dollar really is having a massive influence on an economic chain of causality, and cryptos and Bitcoin would find that they are one of the links along that chain. It's not something that you can look at in isolation. We've got to understand the US dollar is moving up. Why is US dollar moving up? US dollar is moving up because of yields. Why is yields moving up? It's because we are on a contractionary monetary policy. Well, guess what? Tonight is the all-important Fed meeting. Right? We want to see, do they come out with 50 basis points? Yesterday, we saw that they are way behind the curve. We saw the gap between the 2-year and the Fed funds rate is enormous. 50 basis points is priced in, but there is certainly scope for a 75 here. Certainly scope. Okay. Now, the obvious pushback on that is, wait a second. 75 is really going to disrupt the market. It's really going to disrupt the market. Maybe the thinking is, let's just get the pain over and done with. We have to do it. We're so far behind the cliff. So the scope for high volatility this evening is huge. And of course, the news about the quantitative tightening is what we really need to get some more communication on that, because it's going to be huge in terms of sucking liquidity out of the market. What happens when liquidity leaves the market? Well, it starts creating less supply. Less supply, well, that's a boon for demand. Demand for dollar means probably higher dollar prices. Now, this is the big sort of confusion here. What does this overbought condition mean for the US dollar? Certainly it can't stay overbought for very much longer. I would suggest that if the RSI does normalize here, of course we'll see some dollar weakness. That dollar weakness would show up in gold strength, it would show up in Bitcoin strength, but I would be of the opinion that we would still need to be very, very careful there, because the moderation in the dollar might just be the platform for the next leg up. Okay, with that background, what does that mean for us in Bitcoin? I think it means everything. Bitcoin is denominated in dollars. It's like a currency, just like what we said with gold. Bitcoin is your base. US dollar is your counter or your quote. If you see Bitcoin moving up like that, okay, that means the base currency, or in this case, the base instrument, Bitcoin, is appreciating relative to your quote, well, that's US dollars, there's your Bitcoin appreciation. Okay, what's happening right now? Right now, Bitcoin is looking vulnerable. Okay, why is it looking vulnerable? Because the dollar is looking rampant. Okay, so if the dollar is looking rampant, take a look at the technical picture here. What's happened? Okay, well, I think something enormous has happened here. It all depends on, of course, the way the dollar. Let me just go back to the dollar. It all really depends on how the dollar reacts to this overbought condition once we have the Fed announcement, and that's an unknown. And if it's an unknown, it means it's an uncertainty, and if it's an uncertainty, it means it's high risk. Okay, so if that's the case, then Bitcoin falls in that category as well, because the US dollar is a key part of the instrument, Bitcoin to the US dollar. But what's happening here on the weekly? It's fallen out of a technical ascending wedge pattern. Those wedge patterns are continuation patterns. If it's a continuation pattern, it's 1, 2, 2, 3, 1, 2. Prices never move in a straight line. 2, 3, 1, 2. If the trend continues, so we're at a very important technical juncture, because it looks as if we've just broken out of a wedge pattern to the downside. Take a look at your indicators here. Take a look at your indicators here. It's very similar to gold. That's why we started with gold. It's near 50, but it's weaker than gold, because gold was at, I think it was around 45. Here we're at 39. So there's certainly a bearish bias in terms of the RSI. But where the obvious relative weakness in Bitcoin is relative to, say, gold, is the much stronger hinge. It's turned down. It's starting to look quite fragile, because if it makes its way through to 20, okay, that means it's making its way through to 20. It's broken out of an ascending wedge, which is a continuation bear pattern, okay? And if it goes down to the 2011 and holds there, that's going to add a pressure to the Bitcoin. Fine. Technically speaking, okay, we understand that. What are the fundamentals that would make that a distinct possibility? Again, just look at your base here. It all comes down to US dollar. It all comes down to US dollar. The key here is in Anna's comment. The key is, but we're losing money because inflation's so rampant. That's the key. We have to get that inflation under control. Okay, that's what the central banks are in existence for. They all have a price stability mandate. Okay, and they're all missing it. They have to bring the inflation back to target. So they are going to theoretically, they want to front load. When I say they, I'm talking the Fed wants to front load its interest rate hikes. What does front load mean? It means they're going big now. They're going big now. So 50 potentially today, with a scope of a surprise to the upside. Probably, I'm going to sort of put my neck on a chopping block here. Probably 75 in June, and probably 75 after that. How can I be so brazen? It's because the Fed is so far behind the curve. We saw this yesterday. Let's just take a quick look at that again. So we go US 02. So we're looking at the US 2-year here. Okay. Now we're going to add the Fed funds rate to this. Just go plus. All right, I just want to make this again easier to see. I'm going to get all the data in. You'll see exactly. Now, the movement here, the 2-year is a terrific proxy for monetary policy. Of course, there are deviations. It's not a perfect correlation, okay? But the correlation would be very strong, okay? And you can see that it tends to sometimes lead the Fed funds rate, sometimes it lags, but it always seems to be following. Always seems to be following. Well, not in 2022. In 2022, we got a huge gap. What does that gap mean? That gap means the Fed is extremely far behind the curve. That's the most likely scenario. The second scenario, of course, is that the market's gone too far ahead of itself and has to pull back. That would be quite something because the gap here is extreme. It did happen briefly here. This is the only time I can see it. So we have to go back to sort of the 90s to see where there was some sort of overshoot on the bond market. That's the only time I can really see it. I don't have data before that. So some sort of normalization here, one would expect. What's that normalization? Well, the black line, that's the Fed funds rate. It has to catch up to the 2-year, and it has to catch up pretty rapidly. So if it has to catch up pretty rapidly, okay, that's exactly why we see this overbought condition in the US dollar. And as long as that, as long as we've got the Fed playing catch up here, dollar likely supported in a sort of a medium-term basis, there could be daily sort of fluctuations. There's daily fluctuations. Dow called that noise, right? The idea here is, okay, what's the idea here is, the fundamentals are making it difficult for Bitcoin. And what we could possibly suggest is that the 40,000 is a key level to watch because it's a psychological number. And if you're a fund manager, okay, you'll be looking at that 40,000 level very, very carefully, and you're not going to hold an instrument that you think is going to be under pressure. Okay, so you'll be losing interest in it. If you're losing interest in it, where are you going to be putting your money? Well, you may be holding cash. That's the point. So does the QT mean that the Fed doesn't need to raise rates as far? I think, let me ponder this, Rob. The answer to your question is that the answer to your question is possibly. What the Fed is effectively battling with, is finding what we call R star, which is effectively your equilibrium level of interest. So where is R star? So according to this, we would suggest R star around about sort of 2.83%. I have read an article where a previous Fed employee suggested it was at 5%. That probably seems a bit high in my opinion, precisely because we've got the quantitative tightening as well. So there's probably an element of truth to what you are saying, Rob, but I don't think it makes the conundrum less complicated. I think it makes the conundrum more complicated, because if we were just dealing with interest rates, then we could try and figure out, where is the equilibrium? Yeah, when have we caught up? What we're actually dealing with now, let me see if we've got the balance sheet here, is we've got an extra variable, which is a huge unknown. Let me just see if I can find it here. I think it's this one. All right, let's take a look here. not sure what I'm looking at here. Let me just get the let me get the correct graph so that I don't misrepresent. So I'm going. So it wasn't on our slide, but I'm going through to the St. Louis website, which is called Fred. I'll show it to you in a moment. Okay, I'm just bringing it across here. All right, so this is the key to Rob's question. What about the quantitative tightening? So you can see this number here is very important. This is telling you how many, how much, what the assets value is. It's $9 trillion, just about $9 trillion. You can see it is starting to perhaps taper here, Rob, which is interesting, and that's obviously because we've come to the end of bond buying. So I think the question is now, what's the Fed going to do with all this, with all these assets? So the history behind this is here is the COVID pandemic. Fed starts pumping a whole lot of liquidity into the economy. So the way it does that, it buys assets, financial assets, typically bonds along the yield curve, books those into its balance sheet. The money that it's paid for it, okay, the money that it's paid for it will be pushed out into the economy, and that's the liquidity. Well, what happens when it starts selling the financial assets? But it's selling it for money, so it's draining the money out of the economy. So if it's draining money out of the economy, it means there's less dollars circulating in the economy. So if there's less dollars circulating in the economy, well, we've got to ask ourselves, what's that going to do to the US dollar? So the obvious answer to that is that the dollar should theoretically be valued higher, because the less of something there is, the more valuable it becomes. Then, of course, you've got the added layer of earning higher interest rates on the dollar. So it adds a level of complexity there, in that, yes, even if the rate hikes are not as aggressive as initially thought, does it really make the conundrum any less complex? And I would suggest no, it probably makes it more complex, because the dollar then carries on rising, and we start seeing the ramifications along that chain of causality. In other words, the quote here, the quote currency, the denominator, still adds a headwind for Bitcoin, still adds a headwind for gold, still adds a headwind for the bond market. So what looks cheap now becomes cheaper. So that is the conundrum that we're dealing with. Quantitative easing is probably a major factor for what got us into this inflation mess in the first place. Quantitative tightening is equally uncertain. What the ramifications going to be from that? That's a huge question. Nobody knows. Anna asks, will the war spending affect this, or is it too insignificant? I think, Anna, the 9 trillion here, it trumps all, to be honest. I think it really is just a matter of, it's just a matter of the pace of the unwinding of the balance sheet. Are the currencies less affected by inflation, those less negatively affected by oil and gas prices? You see, the thing about the financial markets is there is distinctly an inter-market relationship between all the different facets of the financial markets. It's going right back to Katie's question earlier. Where's the money going? And perhaps we can look at it sort of in a simplified fashion, where we've got this kind of spectrum, we have looked at this before, and you've got your low risk on the left. So what would that be? That would be your sort of money market. Then you would have your government treasuries. Then you would have your corporate treasuries. Okay. Then you would have your stock market. And then you would have what we call alternative investments. This is where Bitcoin will sit, alternative investments. It's also where gold sits, actually, and oil, alternative investments. So you kind of got this interplay here between reward and risk. It's always between reward and risk. And if things become too risky in terms of its reward, money starts flowing that way. So when we were going into the pandemic lockdown, money was flowing this way. That was strange. So that was strange because one would think, well, isn't there more risk? Why is money seeking risk out? Well, the idea here is, of course, because we were being artificially guarded by a quantitative easing. So somewhere in this spectrum, you would find sort of your more volatile currencies and your low volatile currencies. Your lowest volatile currencies probably sort of euro, US dollar, one would expect, although it's been moving, whereas your pound, Japanese yen characteristic is a very high type of a high beta currency. The point is, but the Japanese yen now is also being artificially lowered because the Japanese Bank of Japan is defending the 25 basis points level on the 10-year. So a lot happening, and we've got to try and find a low risk instrument somewhere in this environment. Well, that probably means money flows this way, and probably means money's flowing this way. Countries of high profiting, well, currencies of the Canadian loonie would be a commodity currency that would be generating your Aussie, your Kiwi, your Rand, but they're all getting smashed against the dollar at the moment. They're battling a $9 trillion unwinding. There's not much of a competition there. So that's probably what we're seeing. And guess what? That's what we see affecting Bitcoin, dropping down, dropping out. All right. Any questions there? So I did set my alarm. I've got a meeting in 6 minutes, so I'll have to conclude in a few moments. I just want to know if there's any other questions, and I'm hoping that I've answered all the questions to the best of my capability. Anything that we have left out? COPEC on Bitcoin, sure, we can definitely do that. So we looked at that last week. I don't think that we are in that value. I don't think we're in that value stage, Anna. But let's just take a look. Because you always want to use your monthly. Also, just make sure you use a logarithmic chart, otherwise it's going to look strange. And then just add your COPEC. So that's the wrong. That's the wrong indicator. Let's just use this one. All right, so we're at 136. I mean, last week I think we were over 200, so it's heading towards zero at a rapid pace, but we're not there yet, right? Let's just put this in. We're pretty close there. We're pretty close. Okay. Remember, Anna, just before last sort of point, and then we're going to sign off. Remember, just because the COPEC goes under zero, that in itself is not the signal. When we looked at the Shanghai Composite, it's under zero, but still heading down. When we looked at bonds, it's under zero, but still heading down. So we've got to see it. The red line is 0. This red line is 0. Yeah, it's 0. Cool. All right, guys. I'm going to wrap up there. Thank you so much for joining me, and we'll have a good discussion tomorrow after we get the Fed minutes. A big one in the Fed statement. Thanks, guys. Copac settings are exactly the same. Yeah, exactly the same. All right, guys. Have a good day, and chat to you tomorrow.